and qualified mortgage rule. The Consumer Financial Protection Bureau is an independent federal agency whose mission is to help consumer finance market work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Ixta Martinez. I'm the Acting Associate Director for External Affairs. Welcome. Today's field hearing is being live streamed at consumerfinance.gov, and you can follow CFPB on Facebook and on Twitter at CFPB. We'll begin today's field hearing with remarks from some well-known Maryland luminaries. Then you'll hear from CFPB's Director Richard Cordray. This will be followed by a panel discussion on the ATR and QM rule that will be led by the CFPB's Deputy Director Raj Date. After the panel discussion, audience members will have an opportunity to share their stories and observations with the CFPB. So let's get started. Senator Ben Cardin is a native of Baltimore, a former state legislator, and a member of the House. In 2001, he was named by Worth magazine as among the top 100 people who have influenced the way Americans think about money. The senator was a strong supporter of the legislation that created the CFPB. We thank Senator Cardin for being with us today.
Ixta Martinez, thank you very much for the introduction, for being here. Director Cordray, we thank you for your service to our country and bringing this hearing to Baltimore. And on behalf of my colleagues, we thank you for being here in Baltimore. Congressman Cummings and Mayor Stephanie Rawlings Blake and I have seen firsthand the pain that was caused by people who have lost their homes. We've seen what it's meant to their dignity. We've seen neighborhoods that have been very much negatively impacted because of mortgage foreclosures. And the tragedy of this, that in many of these cases it didn't have to happen. Individuals in our community were steered into subprime products that they shouldn't have been. They qualified for conventional mortgages. But yet they were steered into a financial arrangement that they didn't understand. They didn't realize the consequences. And as a result, many people lost their homes and communities were devastated. Today we have too many abandoned properties, too many homes still in foreclosure, people who are homeless, and still homeowners are uncertain about their future. So we thank you for having this hearing here in Baltimore, because we do believe that the people that will be presenting can give you some good information to help form the policies that we expect from the Consumer Financial Protection Bureau. I want to first compliment Governor O'Malley, Secretary Skinner, our Secretary of Housing, for the steps that our state took to help people. They set up counseling and ways in which the homeowner, the person who had borrowed the money, could have direct contact with the person who lent the money. And in some cases, we were able to adjust mortgages and keep people in their homes. I'm proud of the work that our mayor did in helping the people of Baltimore City better understand their options, because the way this financial arrangements were set up, people couldn't talk to the right people. And it was in everyone's interest to avoid foreclosure, and yet too many properties were being foreclosed. Congressman Cummings had many foreclosure prevention forums. It was amazing. I have seen some of the people who have benefited from Congressman Cummings' work. I held several foreclosure prevention forums, and I was amazed. I expected that I would find maybe 50 or 100 people show up. Hundreds showed up because they were thirsty for information. They had the financial ability, they thought, to save their house, but they didn't know how to do it. And that's what the lesson I think we've learned over the last 5 years. We have to do a much better job. And I must tell you, we can put a face on it. All of us have the individual stories of people that have come up in homes that we have saved as a result of it. There's one person, Fanny, who lives in Bowie, Maryland, would have lost her home. Would have lost her home. She was at one of those forums, Elijah. And she was able, through a counselor, to find out who actually had the mortgage, and through a pro bono attorney, sit down and able to adjust their mortgage through the tools that were made available as a result of legislation passed by the United States Congress with the leadership, strong leadership of the Obama administration. We were able to use the tools and save this individual, Fanny, her home. There are many other stories like that. We've got to personalize this. To me, the key to preserving home ownership in this country, the key to financial success, and I hope the major objective of the Consumer Financial Protection Bureau is to provide financial literacy. Let people understand what's out there. Let them understand their own capacity. Let them understand the options that are there. Financial literacy is critically important. And then access to financial products and services that are fair, affordable, and understandable. If we can take those steps, we can help empower people to not only own a home or to make the right financial decision, but to help build our economy. So I just urge you to be bold. When Congress passed Dodd-Frank, when Congress passed the establishment of this Bureau, we wanted you to be bold because we don't want to repeat what we've seen over the last 5 years again. We want you to be bold in protecting families from abusive financial products. Get rid of them. Empower families with financial knowledge, skills, and resources. We need resources to help guide them, particularly when the choices are complex or when the terms are unclear or when the products themselves are misleading. And I think through proper regulation, best practices, and leadership, we can provide that financial information and we can help people during those critical periods in their lives when they have to make those types of decisions. I think we can guide them. I want to compliment you on the regulations that you just recently issued. They're absolutely in the right things to do. And I can tell you, you have friends in the Congress of the United States who will support your bold actions. Let us work together and avoid what's happened over the last 5 years so we don't have to repeat that. And Americans can indeed have the American dream of home ownership with the right financial arrangements at the right time in their life. Again, thank you for being here in Baltimore, and I can assure you that our congressional delegation, Senator Mikulski, and our entire team are there to work with you to make sure that we accomplish these goals together. Thank you.
Thank you, Senator Cardin. Our next speaker is Congressman Elijah Cummings. Congressman Cummings represents Maryland's 7th Congressional District, which includes our beautiful venue today, Westminster Hall. Representative Cummings is the ranking member on the Oversight Committee, where he has strongly defended the Bureau's independence. We thank him for hosting us today.
Good morning, everyone. Come on, we can do better than that. Good morning, everyone. It is certainly my honor and my privilege to be here, and I am so glad that the Consumer Financial Protection Bureau has chosen the 7th Congressional District, which I just so happen to represent, to hold this forum. You know, as I was sitting there listening to Ben Cardin, I could not help but think about the last time Elizabeth Warren appeared before my committee and how some folks tried to tear her apart because she simply wanted an organization which was meant to protect our constituents. She wanted to make it work. And I can tell you, I was telling Director Cordray a little bit earlier, it's amazing the very people who tried to put her down in their actions elevated her, and now she's a United States Senator. You don't have to clap, you should, because she's in a very significant position. Go ahead and clap. I want to thank you, I want to thank Senator Cardin, certainly, and our mayor, who has just done an outstanding job, and you, Director Cordray, for being here. The Consumer Financial Protection Bureau is dedicated to protecting consumers, including home buyers, from abusive financial practices. Under Director Cordray's leadership, the Bureau conducted enforcement actions last year that returned about $425 million to consumers who were the victims of deceptive practices. This is about $80 million more than the Bureau's entire budget for 2012. So the American taxpayer is already getting significant bang for their buck. Here in Baltimore, we have been hard hit by the national foreclosure crisis, in which nearly 4 million American families have already lost their homes. During this crisis, I've organized some 7 foreclosure prevention workshops, and we're about to have another one on June 15th. And in these workshops, as Ben said a few minutes ago, we've heard firsthand about the abuses committed by mortgage servicers. In addition, in my position as the ranking member of the House Oversight Government Reform Committee, I've conducted investigations and introduced legislation to expand protections for homeowners, including those serving in the military. Given the enormity of the challenges we currently face, we are looking to you, Director Cordray, and the Bureau to lead the way forward. And America is counting on you to ensure that credit is provided on the terms that are clear, fair, and affordable. Today's hearing will primarily address the Bureau's new rule on qualified mortgages, and I'm pleased that the Bureau sought input from stakeholders on earlier drafts of the rule. We are also awaiting a new rule on mortgage servicing standards. We will evaluate all the new rules based on whether they protect consumers from the kinds of abuses they faced in the past, as well as whether they prevent those seeking financial gain from exploiting consumers through unintended loopholes. And as I said to you a little bit earlier, Director Cordray, there are a group of people who are not usually mentioned in these discussions, and that is the children. The children who become displaced because their parents cannot afford the home or they've been put out of a house. And heaven knows what effect that has on generations yet unborn. Does it say to that child that I'll never be able to buy a house? Does it say to that child I shouldn't even try because I'll probably fail? These are questions that never seem to rise up, but I know that you're very, very sensitive to based upon the discussions that we've had. And so I know, Director, you will remain vigilant in monitoring the effects of these new rules on homeowners and on credit. And we urge you to take action whenever new trends threaten the safety or soundness of our mortgage market. And I reiterate what Ben Cardin said. We got your back. I will do everything in my power to back up this organization. It is so very, very, very important. That's why people like the mayor and I are in government. We want to make sure that people have an opportunity to live the very best life that they can. And so with that, again, welcome to our city, and we look forward to hearing from you.
Thank you, Congressman Cummings. Our next speaker is Mayor Stephanie Rawlings Blake. Mayor Blake is Baltimore's 49th mayor. She serves on the board of trustees for the U.S. Conference of Mayors and was the youngest person ever elected to the Baltimore City Council. We would like to thank the mayor for graciously hosting us in her growing city.
Good morning. I'm hosting you in my city and in my law school. You forgot to mention that, Congressman. I want to thank Director Cordray for holding this hearing here today, and I want to welcome the CFBP to Baltimore City. I want to thank the Senator and the Congressman for being here. Baltimore and Maryland is blessed to have a tremendous delegation in D.C. That is working so hard on our behalf, and today is just a small example of the work that they do together. We're always grateful when congressional committees and federal agencies visit Baltimore. And to that end, Director, you're welcome here anytime you'd like to come. We believe that field hearings and visits are an invaluable part of the decision-making process. Policy is far too often made within the confines of Washington, D.C., but a forum such as this allows decision makers to see and to hear what's happening on the ground and how it affects real people. And that can only lead to better policies. What's happening in Baltimore is typical of what's happening in much of America. We have higher than average unemployment and underemployment rates in Baltimore City. This affects people's credit scores and thus their eligibility for mortgages. Foreclosures also destroy a person's credit score, and Baltimore has suffered disproportionately high foreclosure rates throughout the real estate market collapse. And even though interest rates are at record lows right now, there have been significant increases in loan fees, and banks are requiring higher credit scores to qualify for a mortgage. This creates additional obstacles to obtaining a mortgage. And this is not even to mention the government regulations with respect to qualified mortgages, which if defined too rigidly, will only make a mortgage more difficult for minority borrowers to obtain. These obstacles have diminished the pool of minority, low-income, and first-time buyers who are entering the housing market, which in turn has an effect on existing homeowners who are looking to move into a larger home. Existing homeowners are seeking to improve their homes, and they're being prevented from refinancing or obtaining home equity loans. Additionally, here in Baltimore, we've been suffering from high foreclosure rates throughout the subprime meltdown, and this is continuing. Foreclosure rates in the greater Baltimore area rose this year well beyond the national average and even increased from the year before. The foreclosure pipeline, late mortgage payments of 90 days or more, is also on the rise in the greater Baltimore area, increasing from a year before. These are alarming trends and should cause all of us concern. All combined, this creates a very difficult challenge for Baltimore City as we work to create new opportunities for our families and our neighborhoods. We've set out an ambitious goal of growing Baltimore by 10,000 families over the next 10 years, and in order to do so, we must improve our school system, reduce crime, create economic opportunities for our residents. But a vital part of this effort has been making home ownership a priority. In fact, on Monday, we announced a new public-private partnership with Wells Fargo to provide $4.5 million worth of $15,000 grants to provide home ownership assistance. These forgivable grants to new homeowners will help families move into the home that they want. What's more, the new program supports our ongoing efforts like Vacants to Values, our blight elimination program, by providing people with the opportunity to combine a variety of incentive programs, and by doing so, being able to bring tens of thousands of dollars to the settlement table. Still, without access to mortgages, all of these efforts will be for naught, and will make the job of growing the city, and by extension, our nation's economy, that much more difficult. That's why today's discussion is so important. We need to find ways to increase opportunities for families here and throughout the country. Thank you again for my invitation to speak to you today. Thank you for being in Baltimore. I hope you have a fruitful discussion in my hometown, and you're always welcome back. Thank you.
Thank you, Mayor Blake. On behalf of the Bureau, I'd also like to extend wishes for a speedy recovery to Congresswoman Donna Edwards. She was to have joined us today, but unfortunately sprained her ankle. We hope it heals quickly. Next is the Bureau's Richard Cordray. Richard Cordray became the CFPB's first director a little over a year ago on January 4th, 2012. Director Cordray.
Thank you, Zixta. And let me say thank you to everyone, including our elected leaders, Mayor Rawlings Blake, Senator Cardin, Representative Cummings, has been such a strong supporter of the Consumer Bureau and its work. I also want to acknowledge public officials, leading public officials who sent staff to represent them here today, key staff who will report back: Senator Mikulski, Representative Ruppersberger, Representative Van Hollen, and Representative Harris. Thank you so much for your interest in our work. We appreciate it. We take our responsibilities to fulfill the will of Congress very seriously, as with the mortgage rules we're announcing today. So thank you for joining us today as we announce our Ability to Repay rule, a rule designed to ensure that lenders are offering mortgages that consumers can actually afford to pay back. This is a simple, obvious principle that needs to be reestablished in the American housing market. It is nothing more than the true essence of responsible lending. The Ability to Repay rule gets at the heart of the lending standards used in this country to sell mortgages to consumers. It comes against the backdrop of two distinctly different mortgage markets that we've experienced over the past decade. In the run-up to the financial crisis, we had a housing market that was reckless about lending money. It was driven by assumptions about property values that turned out to be badly wrong. It had dysfunctional incentives, with lenders being able to offload virtually any mortgage into the secondary market, regardless of the quality of the underwriting. There was broad indifference to the ability of many consumers to be able to repay their loans. As a result, we experienced the worst financial crisis since the Great Depression. The collapse of the housing market destroyed businesses and jobs across every economic sector and in communities across this country. The American dream of home ownership was shaken to its foundations. Household wealth shrank by trillions of dollars. The stock market plummeted. People's life savings were devastated. People lost their jobs. People lost their homes. People lost their hope and confidence in the future. Now, in the wake of the financial crash, we've been experiencing a housing market that's tough on people in just the opposite way. Credit is achingly tight. Since 2008, most mortgages are being priced on very attractive terms, but access to credit has become so highly constrained that many consumers cannot borrow to buy a house, even with strong credit. Both periods have hurt individuals and families who simply seek to fulfill the promise of the American dream of home ownership. Our goal with the Ability to Repay rule is to make sure that people who work hard to buy their own home can be assured of not only greater consumer protections, but also reasonable access to credit so they can get a sustainable mortgage. Let me tell you two sets of stories that reflect the problems I'm talking about. Earlier this year, a California man named Henry wrote to the Consumer Bureau. His home was in the process of being foreclosed on, and he was desperate. During the overheated years, a lender had sold him a mortgage for more than $500,000, far more than he could afford on his annual salary of less than $50,000. And despite various provisions in the original loan, he was now arriving at the point of financial ruin. Henry said that when he got his mortgage, he assumed that the lender knew what it was doing by qualifying him for such a large loan. When he wrote to us, he was worried not only about losing his home, but about losing his family's entire future. As we all know, Henry was not alone. People across the country were sold mortgages that were not sustainable. Some had their eyes open, seeking to ride the wave of rising housing prices. Others, like Henry, were led astray. For many borrowers, the numbers were ignored or fudged to get the loan approved. This kind of reckless lending was an endemic problem. I firmly believe that if the Ability to Repay rule we're announcing today had existed a decade ago, many people like Henry could have been spared the anguish of losing their homes and having their credit destroyed. The events that caused the financial crisis might well have been averted. The tragic reverberations that continue to affect so many Americans today would never have occurred. In contrast, consider these more recent situations. Anthony from New York contacted us earlier this year to describe how, after years of building a strong credit report, he now finds that even with a solid credit score and money saved for a substantial down payment, he cannot get approved for a mortgage. After all those years of carefully managing his money, he found that the current market has become so tight he cannot get the approval he needs. And the slowdown in the mortgage market is holding back consumers in other ways, too. We heard from a couple in Michigan who have credit scores in the 800s and simply want to refinance their home, which is now worth much more than the original mortgage loan at the current lower rates. Yet they cannot get approved because there were no comparable sales in their neighborhood over the last 12 months. Having the important ability to repay rule in place, indeed having all the mortgage rules in place and on sound footing, is an essential foundation for our much-needed recovery in mortgage lending. We believe this rule does exactly what it is supposed to do. It protects consumers and helps strengthen the housing market by rooting out reckless and unsustainable lending while enabling safer lending. In the end, the ability to repay rule will help ensure that lenders and consumers share the same basic financial incentives. Both of them win when borrowers can afford their loans. It also recognizes the importance of restoring reliability to the marketplace. When consumers sit down at the closing table, they should be able to have confidence they're not being set up to fail. With this confidence, consumers can be more active participants in the market once again. They can choose the product they believe is best for them from among a wide variety of products, and they can decide what they're willing to pay to finance the home they seek to own. The core of the ability to repay rule rests on two basic common sense precepts. Lenders have to check on the numbers and have to make sure that the numbers check out. Why is this so important? Again, consider where we were just a few years ago in the mortgage market. Leading up to the crisis, many lenders sold no-doc and low-doc loans, where consumers were qualifying for loans that were well beyond their means. A no-doc loan is one where the borrower did not have to show any financial background or resources, such as tax forms or paychecks or bank statements, none of the critical information needed to evaluate what size mortgage he or she could reasonably afford. Some of these loans were derided as ninja loans. No income, no job, no assets, yet far too many borrowers found that they had no problem getting these loans approved. Taking the actual financial background of the consumer out of the equation was problematic. The rapid spread of introductory teaser rates made a bad situation worse. Low initial teaser rates led many consumers to believe they could afford to take out loans, but the payments proved too much for many consumers and caused a dramatic increase in mortgage delinquencies. This led inevitably to home foreclosures. Under our new rule, lenders will have to determine a borrower's ability to repay. They will have to evaluate the borrower's income, assets, savings, and debts. And this determination will be based on both the principal and the interest on the mortgage over the long term, not just during an introductory period. Under our new rule, low and no-doc loans will be effectively prohibited in the American mortgage market, and affordability will be determined based on the interest rate that would prevail in the absence of any teaser rates. In these key respects, borrowers no longer will be sold mortgages that are predestined to fail. Now, while Congress directed the Bureau to implement the ability to repay rule, it also directed us to define a category of loans where borrowers would be the most protected. So as part of the rule, we're releasing the criteria for what are called qualified mortgages. If you're a borrower getting a qualified mortgage, your loan is required to meet these additional criteria, and thus, barring some unexpected turn of events, you should be able to make your house payments. Under our new rules, qualified mortgages cannot contain certain features that often have harmed consumers. They cannot have excessive points and fees, which are the upfront costs that the lender imposes on the borrower at the outset of a loan. They cannot be risky loans where the principal amount actually increases rather than paying down the loan. And they cannot be loans that place a particularly large financial burden on the borrower. The consumer's total monthly debts, including the mortgage payment and related housing expenses such as taxes and insurance, generally cannot add up to more than 43% of a consumer's monthly gross income. No standard is perfect, but the standard here draws a clear line that that will provide a real measure of protection to borrowers and increased certainty to the mortgage market. Taken together, all of the ability to repay provisions will help establish the principles of responsible lending for the mortgage market as it recovers from the financial crisis. But you cannot have responsible lending unless you have lending in the first place. And the mortgage market as it stands today has tightened so much that many consumers cannot borrow to buy a home, even with a strong credit history. We can draw up the greatest consumer protections ever devised, but if consumers cannot get credit, then there's nothing to protect. Our goal here is not only to stop reckless lending, but to enable consumers to access affordable credit. Our ability to repay rule will restore more certainty to a market that was deeply destabilized by the financial crisis. By providing common sense discipline in the housing market, this rule creates a level of assurance for all participants that will open up more access to credit for consumers. And we are helping this process along in two ways. First, we've included provisions in the rule that temporarily broaden its coverage of qualified mortgages to allow a transitional period while other parts of the government, including the Congress, map a path forward toward reform of the secondary market for mortgage financing. Second, we've addressed the legal consequences of a qualified mortgage by conferring the strongest legal protection on safer prime loans, while permitting borrowers to rebut the presumption of ability to repay for subprime loans. We have limited the opportunities for unnecessary litigation, however, in three ways. One, by drawing bright-line criteria to define a qualified mortgage. Two, by specifying that sustained payment over a reasonable period is strong evidence that the borrower had the ability to repay the loan when it was made. And three, by specifying the circumstances under which a borrower can rebut the presumption for subprime loans. There has been some confusion about what these legal protections actually mean. They do not afford lenders complete immunity when it comes to foreclosures. For example, if a lender does not follow the qualified mortgage criteria, then the lender does not enjoy the legal protection of a qualified mortgage. And the protections conferred on borrowers under other federal consumer financial protection laws still apply. Thus, the ability to repay rule does not take away any consumer rights. It adds to them. And for lenders who make qualified mortgages or determine the consumer's ability to repay over the life of the loan, this rule will foster consumer confidence and improve conditions in the marketplace. While working on the ability to repay rule, we came to another important recognition. Many have said, including myself, that community banks and credit unions did not cause the financial crisis. Their traditional model of relationship or character lending has been beneficial for many people in rural areas and small towns across this country, including the small town in Ohio where I was born and raised. They find ways to make loans that respond to personal situations and cannot be captured by any generic metrics. They depend on keeping a good reputation in the community, and they often hold these loans in their own portfolio. Accordingly, they have strong incentives to pay close attention to the borrower's ability to repay. So today we will also be proposing a further adjustment to the ability to repay rule to create a special category of qualified mortgage loans made by smaller lenders such as community banks and credit unions. This proposal also contains measures to ensure that nonprofit groups and state housing agencies that lend to low and moderate income families can continue to play a vital role in the housing market. These groups offer a valuable range of financing and support, from down payment assistance to first-time homebuyer programs to construction programs that build up communities one beam at a time. We look forward to considering your feedback, which has been so helpful to us in resolving the many difficult challenges posed by the ability to repay rule. We've adopted today's rule after analyzing extensive comments and considerable data. We have listened to people with many different perspectives and stakes in the housing and mortgage markets. We've met with large providers, small providers, community groups, consumer organizations, and public officials from every branch and level of government. The work done by our team on this rule has been marked by their tremendous talent and dedication. And yet their work is not done. We have a responsibility not just to write a rule, but to see that lenders put it in place effectively so that its promise for consumers becomes reality. And we also want to help lenders implement the rules smoothly and minimize unnecessary burdens. So we've hired a mortgage industry veteran to coordinate these efforts. We will also be working closely with industry over the next year to aid and support implementation of the ability to repay rule and all of our other mortgage rules. We will publish plain language translations of the rules in booklet and video form for lenders and other key players in the real estate market. We will field questions and offer suggestions to help lenders determine how to implement the rules. And in coordination with our fellow agencies, we will publish materials that help lenders understand our supervisory expectations. As the effective date approaches, we will also give consumers extensive information about their new rights under these rules. On a final note, I believe it is entirely fitting that this rule, one of our most important to date, would focus on making sure that lenders pay close attention to whether borrowers are able to repay their loans. It is fitting because it brings us back to the very origins of our mission. 5 years ago, then Professor Elizabeth Warren wrote a groundbreaking article entitled "Unsafe at Any Rate." In it, she asked why we as a country had made it impossible to buy a toaster with a 1 in 5 chance of bursting into flames and burning down your house. Yet it was still possible to finance a home purchase with an exploding mortgage that has the same 1 in 5 chance of causing your family to be put out on the street. She advocated that financial products should be subject to regulatory oversight because the pain imposed by a dangerous credit product is even more insidious than that inflicted by a malfunctioning kitchen appliance. Spurred by the tragedy of an intervening financial crisis, Congress and the President took action, and her vision became the Consumer Financial Protection Bureau. As the American mortgage market ebbs and flows, the new Consumer Bureau has been charged with the duty to protect responsible lending in the housing market for borrowers, lenders, and everyone else who's engaged in our economic life. We have been working hard, and we will continue to work hard to do just that. Thank you.
At this time, I'd like to invite all the panelists to join the stage. And while they are taking their seats, I want to also thank those who are joining the field hearing by live stream. You can follow CFPB on Facebook and on Twitter at @CFPB. The CFPB's Deputy Director, Raj Date, will lead the panel of experts through brief statements and Q&A. Raj Date has had a long and varied career in and around U.S. financial institutions as a strategy consultant, a bank executive, and on Wall Street. Previously, he served as special advisor to the Secretary of the Treasury for the CFPB and as the Bureau's Associate Director for Research, Markets, and Regulations. In 2009, Deputy Director Date founded and served as Chairman and Executive Director of the Cambridge Winter Center for Financial Institutions Policy, a private nonprofit research and policy organization that supported reform of the U.S. financial system. Deputy Director Date, you have the floor.
Thank you, Zixta. Thank you all for being here. I'd like to start just by reiterating something that was said by Senator Cardin and then again by Director Cordray. Just to remind everyone that the CFPB is a startup agency. We were established some 2.5 years ago. We opened for business a 1.5 years ago. And I'm quite proud about what it is that we've been able to accomplish. But just as important as what we do is how we try to do it. We try to be disciplined and data-driven and tough-minded. But at the same time, we try to make sure that we're open and transparent and collaborative with stakeholders around the very important work that we're doing. We try to make sure that we hit every deadline, and we never forget who it is that we work for, which is the American consumer. Doing all of that is hard work, and it takes a certain human cost, a human toll on people. And I just wanted to pause and thank the astonishing work of the staff at the Bureau, led by David Silverman, who is our head of research and markets and regulations. But I would like to, mostly because I can, let's run through some of the people who have really done astonishing work. So Kelly Cochran, who runs our regulations team, which includes Ben Olson and Stephen Shin, Paul Mondor, Tom Carney, Priscilla Walton-Fine, Courtney Jean, Eamon Moran, Jennifer Cosma, and Joe Devlin. Our research economists who do such terrific empirical work that grounds this effort as well as others, led by Jesse Leary, Ron Borzakowski, Alexei Alexandrov, Tim Critchfield. Our mortgage markets team is led by Pete Carroll over here to the director's left, and including such terrific team members as Ren Aseen And of course, our legal division with Roberto Gonzalez and Stephen Van Meter and Ann Zork and Connor Razzo, all have put in terrific work on this rulemaking. And I personally could not be more proud or more grateful for the work that's been done. There's always a danger when you just try to come up with everyone who's worked. You inevitably miss someone, and then they're angry at you. I've always been very comfortable with people being angry at me, though, so I don't mind. Let me just talk a little bit about what it is we'd like to accomplish during this component of our public hearing. As Director Cordray talked about, the ability to repay rule is focused on solving real problems that when they manifested themselves had a devastating impact on the mortgage market, on the housing market, and on the real economy. To help us calibrate within that context the impact of this new rule, and importantly, to help us with gleaning a perspective on where the marketplace and consumers' interaction with it might move from here, we have assembled two terrific panels, which together have deep insight and perspective on the experience of consumers and the experience of lenders, and indeed the experience of the mortgage finance market broadly. I would like to introduce that panel and then ask each of our panelists to provide a brief opening statement. These are really terrific people who have joined us, and notwithstanding the fact that they are so terrific, we will ask them to be quite brief in their opening remarks. But let me first introduce you to all of them. Over on my far left-hand side is Mike Calhoun, who's the president of the Center for Responsible Lending. Next to him is Lisa Rice, vice president for the National Fair Housing Alliance. Then Elise Cohen, staff attorney for the National Consumer Law Center. And then if I move all the way to my right-hand side, Susan Wachter, who is a professor of real estate and finance at the Wharton School at the University of Pennsylvania. David Moskowitz, who's deputy general counsel with Wells Fargo. And Karen Thomas, the senior executive vice president for government relations at the Independent Community Bankers Association of America. Thank you all for being here. And perhaps we might start with you, Mr. Calhoun.
Thank you. Today, the CFPB announces one of its most important rules, the Qualified Mortgage Ability to Repay rule, along with the upcoming mortgage servicing rules that will come out next week, address failures in the mortgage market that devastated millions of families and our overall economy. The twin drivers of this were widespread, unaffordable loans and a broken mortgage servicing system that severely aggravated the ensuing wave of foreclosures. The goal of the Dodd-Frank legislation and the rule today are to redirect incentives so that lenders are encouraged to make loans that are long-term sustainable, not just generators of short-term fees, and to also deter and prohibit abusive practices, such as the infamous 228 exploding loans, and broker incentives to steer borrowers to more expensive, less sustainable loans. At the same time, as noted, we need to provide more access to these sustainable loans. The rule being announced implements and reinforces the key protections mandated by Dodd-Frank and appropriately targets the strongest protections at the riskiest loans. It will provide substantial certainty and protection for lenders in order to encourage ample access to credit. There remain several key provisions, as discussed in comments earlier, left for decision, including how some additional provisions will be resolved, including broker incentives that played a key role in the housing crisis. As this rule and the servicing rule are adopted and implemented, it is critical that we not fall into the false argument that enforceable consumer protections mean less access to sustainable loans. As experience in the mortgage market and other consumer credit markets show, basic rules of fairness that encourage sustainable lending further both consumer protection and access to credit. The currently constrained mortgage market is not due to borrowers bringing a wave of claims and that discouraging lenders. Indeed, there has been a dearth of consumer claims, notwithstanding the historic recent abusive lending practices. Rather, the market rightfully lost faith in the quality and safety of mortgages because of the absence of basic protections, which generated a race to the bottom where tricked-up loans dominated, harming consumers and investors alike. We have seen this in other markets as well, such as with credit cards, where the adoption of common-sense reforms in the last few years has produced a more transparent and competitive market that better serves consumers and lenders alike. So in summary, the CFPB fully implementing the Dodd-Frank mortgage protections and enacting substantial reform to mortgage servicing are essential to achieving a mortgage market that works well for families, for lenders, and for our whole economy. Thank you.
Thank you, Mr. Calhoun. Ms. Rice.
Thank you so much for inviting me to participate in this very important hearing. The National Fair Housing Alliance, like Mayor Rawlings Blake, shared that same concern that the QM market would be very narrowly prescribed, and so we're very happy to see that QM is broadly defined and that there are also no down payment or credit scoring requirements for QM loans. We're also pleased that the CFPB's intentions in drafting these rules are to protect consumers from irresponsible mortgage lending. There still remains a concern about the possibilities for reinforcing America's dual credit market, in which communities of color have been relegated to non-prime markets and higher cost loans. A dual credit market, as we all know, helped to create our nation's worst housing crisis. The rules establish a tiered system, one where there are some loans who have the rebuttable presumption and other loans that have the safe harbor. The National Fair Housing Alliance strongly advocated for a scenario where all loans would have a very strong rebuttable presumption, because we felt that that would lend the greatest protections to consumers. Remember that in that mortgage transaction, it's always the lender that has superior knowledge over the consumer in the transaction. So we have to be very vigilant and ever mindful and watchful with this system to make sure that the tiering of the mortgages does not perpetuate a situation where we have furtherance of a dual credit market. We, of course, don't have to look any further than right here in the city of Baltimore for evidence of the effect of a dual mortgage market. One of the nation's largest cases of discrimination was brought by the city of Baltimore on behalf of its African American and Latino residents who had received subprime and higher cost unsustainable mortgages when they actually qualified for lower cost and sustainable mortgages. HUD, DOJ, and other agencies have brought a record number of fair lending claims, revealing that hundreds of thousands of borrowers were discriminated against when they obtained their mortgage loans. And many of these discriminatory actions, of course, have led to borrowers being underwater or even losing their homes. One of the things we are heartened by is the prominence of the Office of Fair Lending and Equal Opportunity, which of course is housed at the CFPB. This office is charged with ensuring that rules like the QM rule and the ability to repay rule will be implemented in a fair manner, and that the CFPB's supervision and enforcement efforts are comprehensive and diligent. It's also important to note that the safe harbor provision does not exempt lenders from discrimination or fair lending claims. Even borrowers who receive a safe harbor mortgage or a qualified mortgage can experience discrimination. So that's a very important point to keep in mind. It would also be important to ensure that compensation schemes did not contribute to consumers receiving higher cost mortgages when they really qualify for lower cost products. We know that certain compensation schemes helped to spur the crisis. The CFPB will therefore need to be very careful to not interpret this rule or to promulgate any other rules that will allow for a perverse compensation scheme. We commend the CFPB for releasing this rule, and of course we'll do all that we can to ensure that the rules provide fair and equal access for all consumers.
Thank you very much, Ms. Rice. There's obviously some audio feedback, which at first I thought was either a practical joke that someone was running. Every time you say QM, the audio system will go on the fritz. Hopefully that'll get worked out. I'm going to use my engineering knowledge now. If you were to separate those microphones, I wonder if that will help us a tiny little bit. In any case, Ms. Cohen.
Thank you for the opportunity to testify today. I testified today on behalf of the National Consumer Law Center's Low-Income Clients and the National Association of Consumer Advocates. We appreciate the vigorous and thorough work of the Bureau on this rule. Regulation of the mortgage market under Dodd-Frank is essential to our economic security. In the years leading up to the economic crisis, pricing replaced underwriting as a risk control mechanism in the subprime market. Lenders relied on securitization to spread the cost of the inevitable foreclosures. Foreclosures devastated communities across the country, particularly communities of color. Congress's mandate in Dodd-Frank is clear. Lenders must take reasonable steps to ensure that every mortgage loan is affordable when made, and homeowners whose lenders overreach have recourse. The Consumer Financial Protection Bureau's new regulations implement important new protections for sustainable lending, but they fail to fully deliver those protections. The Bureau laudably offers a rebuttable presumption for subprime borrowers, a chance for homeowners in this soon-to-be re-emerging market to seek redress if they receive a qualified mortgage that the lender should have known was nevertheless unaffordable. This important backstop against abusive lending will not be available in the prime market. The safe harbor the Bureau has afforded for prime loans provides shelter to lenders who knowingly make unaffordable loans in direct violation of congressional intent. While the qualified mortgage definition guards against many abuses of the recent crisis, without a rebuttable presumption, new abuses will flourish. For example, a 43% debt-to-income ratio in the rule is a helpful starting point and may be a reasonable standard for a homeowner earning $10,000 per month. But for a homeowner earning only $1,000 per month, 43% does not leave enough to pay the utility bills and other essentials. A residual income analysis that looks at the actual cash available is essential in assessing loan affordability for low-income homeowners. And adjustable rate mortgages with exploding payments can meet the qualified mortgage definition, so long as the payments increase after the initial period covered by the rule. The Bureau intends to seek further comment on the treatment of yield spread premiums, payments by lenders to brokers to upsell homeowners into needlessly expensive loans. These payments must be clearly and fully included in the cap, as they are in the statute, to avoid the resurgence of abuse by brokers. Limits on compensation are not enough to constrain this abuse. A rebuttable presumption does not create significant litigation risk to the market. Few homeowners find an attorney, fewer prevail. Individual homeowners face a heavy factual burden to overcome, and due to the fact-intensive nature of the inquiry, class actions are not viable. The Bureau's qualified mortgage rule invites abusive lending in the prime market and erodes the extent of the progress made by Dodd-Frank. Combined with the lack of a rigorous market-wide loan modification mandate, this rule makes progress but still leaves homeowners and the market vulnerable to a future crisis. Thank you.
Ms. Cohen, thank you. Professor Wachter, thank you for being here. May we have your statement?
Thank you, Raj. While there is much work to be done to repair our nation's housing markets, the step that has been taken today is an important, even a landmark one, for the future of the nation's housing finance system. A safe and sound mortgage system must be built on trust. Trust that processes of mortgage underwriting have integrity and are known and controlled. Today's step goes a long way to bringing trust back to the mortgage finance system. It does so not by prohibiting mortgage products, but rather by establishing standards to ensure that underwriting risks in the origination of mortgage loans are controlled and known. We have come through a crisis of historic dimensions. Elsewhere, I and co-authors have noted that at the root of the failure of the mortgage system were informational problems that prevented mortgage participants from knowing and accurately pricing the risk of mortgage products. At the heart of these problems was a failure to properly assess borrowers' ability to repay their mortgages. Only in retrospect can we see how severe this failure was. In real time, market participants could not have known how many mortgages were issued to borrowers who did not have the income to repay principal, interest payments, fees, etc. As a result, consumers and market participants underestimated the likelihood of both borrower default and indeed the system failure that resulted. The housing finance system is more than a market for profit. It is a social contract that can enable safe and sustainable home ownership. When we abuse that contract, we do not simply harm the economy. We rob our citizens of their trust in this American institution. Ensuring borrower ability to repay is more than a precaution. It is an essential ingredient in the fair treatment that citizens deserve as borrowers, as consumers, and as Americans. The new rule announced today will put us on the path to restoring the integrity of the system. Thank you.
Thank you, Professor Wachter. Mr. Moskowitz.
Thank you, Deputy Director Date, and thank you, Director Cordray, and the entire talented and obviously exhausted Bureau staff for reaching this momentous day. The publication of the Ability to Repay rule really is of tremendous importance to American consumers and to help achieve stability in the mortgage market and to solidify sustainable home ownership. We have long believed that a broad and clear qualified mortgage definition under the rule is the best way to support robust originations in the primary mortgage market and to enhance liquidity in the secondary market. The qualified mortgage rule codifies a strong nationwide ability to repay standard that, when consistently applied, will protect consumers and assure the availability of credit. It will also help assure that qualified loans are available across the entire credit spectrum. The release of this rule is an important milestone. The true impact to consumers will not be known until the rule is implemented and made operational by lenders over the course of the year ahead. And we applaud the Bureau's commitment to the implementation process that will be transparent and flexible and will result in the best outcome. We appreciate the thorough and inclusive approach the CFPB has taken in developing the rule, and we compliment the Bureau's willingness to engage stakeholders to consider new information and perspectives and to develop a balanced rule that protects consumers while ensuring that home loans remain broadly accessible. The Bureau's decision last year to reopen the comment process fostered deeper dialogue about the role of consumers' debt-to-income ratios in defining qualified mortgages, identified issues with litigation risks, and related consumer costs. In addition, the Bureau has rightly placed significant emphasis on collaborating with other regulators, including the Federal Reserve Board and the Federal Housing Finance Agency. We urge the Bureau to continue this important partnership as other important regulations are finalized, particularly the qualified residential mortgage rule. The rule issued today represents a framework for the implementation of ability to repay requirements, but it won't answer all of the questions that will arise during implementation. Other factors that are still outstanding that are important to resolve over the months ahead are the importance of FHA reform, credible movement towards GSE reform, and a prompt resolution of those QRM issues. These will help assure stability and certainty in the market. We are looking forward to working with the Bureau in the months ahead on the implementation of this rule and commend the Bureau and its staff again for its expertise and its commitment to stabilizing the market and assuring the availability of credit across the spectrum.
Thank you, Mr. Moskowitz. Ms. Thomas, your statement, and I think we'll probably have better luck with the microphones, I am told, if you just pull it quite a bit closer to you.
Thank you, Raj. Director Cordray, thank you for convening today's field hearing on mortgage policy. I'm very pleased to be here to represent the views of our nation's 7,000 community banks. Community banks play an important role in our nation's economy and in mortgage finance. They are locally owned and operated institutions, and they have very strong ties to their communities and their customers. In many small towns and rural communities across the country, the local community bank is the only reliable source of credit for home purchases. Community banks have a vested interest in the economic well-being of their customers and communities. Their business model is relationship-based, not transaction-based. They did not engage in the lending and servicing practices that contributed to the recent financial and foreclosure crises. They are responsible, common-sense lenders, and the low default rates for mortgage loans that were originated by community banks bear this out. ICBA understands the intent of Congress and the CFPB to prevent mortgage abuses from occurring in the future and to stabilize the housing market. Nevertheless, we're concerned that the plethora of regulatory changes in the consumer market policy could further stymie the housing market and community banks' ability to provide mortgage loans to their customers. And for this reason, we've urged the CFPB and other regulators to tailor the rules so they don't inhibit community banks' ability to provide mortgages. Many community bank mortgage loans are held in portfolio and they're not sold on the secondary market. So the banks have a vested interest in how the loans perform, and accordingly, their underwriting for these loans has historically been more conservative. Many of these loans are not cookie-cutter loans found in the suburban and urban markets. They're made to borrowers who cannot qualify for a secondary market loan, and not because they don't have the ability to repay, but because their properties may be unique. It may be a large parcel or have outbuildings that don't qualify for the secondary market. And like the example that the director mentioned earlier, there may not be comparable sales in the requisite geographic area or time frame to qualify for secondary market loans. But community banks are especially adept at making the loans because the bankers know their customers and have extensive knowledge of the housing market in their local community. The standards and definitions set in the qualified mortgage and ability to repay rule will have far-reaching impact in the mortgage market. Borrowers on the wrong side of the QM will not be able to get the mortgage they want, or they will pay considerably more for it. Many community banks would cease or significantly curtail mortgage lending if there were only a rebuttable presumption of compliance for qualified mortgages. This is because they simply would not be able to absorb the compliance and litigation risk. Therefore, ICBA has strongly advocated that the rule provide a safe harbor for loans deemed to be qualified mortgages. We have also urged that community bank mortgage loans held in portfolio and serviced for the life of the loan receive this legal safe harbor. We are pleased that the Bureau recognized these concerns in crafting the final rule and the proposed amendments. We believe that the safe harbor for qualified mortgages, which includes rural balloon payment mortgages, will enable the nation's community banks to continue to serve their clients and communities while providing safe, sound, and affordable mortgage credit. We look forward to working with the Bureau as the rulemaking process moves forward. Community banks recognize that mortgage finance is now at a crossroads, and we urge policymakers to continue to take the path that will enable community banks to provide mortgage loans to their customers so that these consumers, too, can achieve home ownership. Thank you.
Thank you very much. What we'd like to do is take a few minutes for myself and my colleagues from the Bureau to follow up on some issues that were raised in the statements. And I will take the liberty of beginning. Perhaps by asking our consumer panel just to maybe elaborate on one theme. The ability to repay rule and the qualified mortgage definition are meant to solve important problems. They are not intended, nor can one imagine it being some kind of global panacea. But within the context of other protections that already exist or were created by Dodd-Frank, how is it that you view the impact of this rule moving forward? Ms. Cohen, perhaps this time we could begin with you.
Thank you. The ability to pay requirement is part of the Truth in Lending Act, which has been around for several decades, and it was built on the notion of disclosure being the answer to market issues, something that Professor Wachter alluded to earlier. This provision is really a step in a new direction, which is to say disclosure matters, we need better information in the market, but in addition, substantive fairness is a key part of having a functioning market. Having a clear standard like the Bureau has issued will enable that to occur, and having it issued by an agency that for the first time has its main goal and focus, the benefit of consumers, is also a novel set of regulations and a novel paradigm. This is your first significant mortgage rule, and we congratulate you.
Ms. Rice?
Okay. Let's hope the mic works this time. Raj, thanks for the question, and it's a very important one. One of the things that we advocated for in the lead up to the crisis were for regulators to adopt a set of rules that would apply across the market very broadly, because we were seeing very grave differences between loans that were being originated in the subprime market or the Alt-A market versus the prime market, the conforming market versus the non-conforming market. And what we wanted were uniform standards that would be applicable across the board to all mortgages so that we could help standardize the mortgage experience for consumers, but also ensure basic protections for consumers. And as you've already said, Raj, the ability to repay standard is not a panacea. Just because we have this, it doesn't mean that we will no longer see abuses in the marketplace. But what it does do is it takes us in that direction of establishing uniform sort of base standards, safety standards for all mortgage loans in America.
Thank you. Mr. Calhoun.
One of the reasons this rule will be so important is it sets standards that not only apply for this rule, but are widely anticipated to be adopted in other important ways. For example, there already have been legislative proposals that the government agencies that insure loans can only insure qualified mortgages. This rule relates legally, is tied to another rule that addresses whether those who securitize mortgages have to set aside extra capital, and they will have to set aside extra capital for those loans that are not QM. So it not only provides a definition for this particular rule, it's seen widely as adopting standards that will largely define the market. And it does so, I think, appropriately in three categories. There hasn't been a lot of discussion, but there are actually three categories coming out of today's rule. It's what are prime QM loans? And the idea is the rule sets up incentives to align those of lenders and borrowers so that if you make a prime QM loan, the borrower should have a strong likelihood of success in that loan. In the subprime space, I think it's important that even before the housing crisis, those loans carried very significant risks for borrowers. Our organization's data showed that before the crisis, back in the late 1990s, 2000, if you took out a subprime loan, such as in Charlotte, your chances were 1 out of 3 that you would end up losing that home. And so appropriately, those loans should be available, but with great care. And then finally, there's a third category not addressed today. These rules also affect the so-called HOPA, or very high-cost loans. So in today's market, that would be a loan with more than 10% interest, for example, as compared to the 3.5% interest that most people get today. And again, even more so than subprime, those loans shouldn't be prohibited, but they should be limited to very extraordinary circumstances, and there should be very, very strict protections there. And I think this is a movement in that direction and comes close to hitting that mark right.
Thank you. I want to invite one of my colleagues, Pete Carroll, is our Assistant Director for Mortgage Markets. Pete, would you like to inquire of the panels?
Thanks, Raj. This next question is for Professor Wachter. If the ability to repay rule had been in place in the lead up to the financial crisis, what might this rule have meant for consumers?
Thank you for the question. In the run-up to the crisis, borrowers may have assumed that lenders were in the business of offering repayable loans. But in the event, too many loans were made which could not be repaid. I believe that this rule would have prevented such loans from being made without appropriate warning to consumers, and thus would have prevented much suffering to borrowers and harm to America's communities and indeed the broader economy. Thus, it's an important step forward.
Zixta?
Thank you. This next question is for Lisa Rice of the National Fair Housing Alliance. Lisa, most folks would generally agree that underwriting standards were far too loose in the lead up to the crisis and that they're currently too restrictive. What does this rule mean for extending access into the non-prime mortgage space going forward?
Zixta, thank you for the question. I'm reminded of the first predatory lending case that I worked on. This is in the early 1990s. It involved a senior citizen, a single female head of household who had owned her home in Toledo, Ohio for years, for decades. She had a prime mortgage that she had been paying faithfully. She had stellar credit. She was convinced to refinance out of that prime sustainable mortgage, fixed rate mortgage with Charter One Bank into a subprime loan to get a debt consolidation loan. And she was convinced to do this because the lender told her you're going to have just one payment, and that really appealed to her because she was on a fixed income. The lender was going to pay off all her other debt. Well, of course, you know the story. At the closing table, all of the terms and conditions were completely changed on their head. She got a subprime loan that the interest rate was more than double the prime rate that she had been paying, and of course the lender did not pay off all of her debt. So her debt to income, her total debt to income ratio, of course, skyrocketed. And she didn't realize what had happened to her until after the loan had closed. So I relate that story because it typifies for me, in terms of my experience, what I have seen with consumers over and over and over again, and that is that consumers who qualified for prime credit got steered into the subprime market, as you heard Senator Cardin say. The Wall Street Journal commissioned a study not too long ago, several years ago, in which they looked at certain vintages of subprime loans. And one of the vintages, they found that over 61% of the folks who had gotten subprime loans qualified for prime loans. So it's our hope that this rule will help. It's just one peg. When I think of access to safe, sound, quality credit, I think of it sort of as a wheel with all of these spokes. And the ability to pay standard and the qualified mortgage standard are two of the spokes in that wheel that are necessary to make sure that we have access to sustainable and affordable quality credit. So I think the rule is a very important one for us going forward, and I think that not only is the rule important for making sure that we're extending safe credit in the non-prime sector, but also it's an important component. It's one of the important components to making sure that consumers who really do qualify for lower cost mortgages can get those loans.
Thanks, Lisa. This next question is for Elise Cohen, staff attorney with the National Consumer Law Center. Elise, within the context of the qualified mortgage definition, in your opinion, what does a rebuttable presumption of compliance mean for consumers?
Thank you, Zixta. First, let me applaud the Bureau for the detailed articulation of the rebuttable presumption for subprime borrowers that appears to be included in the rule. We look forward to reading it, including the use of residual income as an articulated reason for rebutting that presumption. So the rebuttable presumption, what is it? It's the opportunity to show that your loan was foreseeably unaffordable when it was made, even if it meets the definition of a qualified mortgage. It's the chance to save your home if you can prove your case. While the qualified mortgage definition promotes more sustainable lending, there are always gaps, like there were after HOPA, and new products develop. The rebuttable presumption helps address those instances. But beyond consumers, the issue also relates to how the market functions. The main goal of the rule is to incent sustainable lending and good behavior. The limited liability in the rebuttable presumption steers lenders away from unaffordable loans. The structure of having a safe harbor for prime loans and a rebuttable presumption for subprime loans may also promote more lending in the prime space. But with that full legal insulation of the safe harbor, lenders will also push the envelope on abuses. And abuses migrate to unregulated portions of the market because the homeowner has no chance to show that the loan was unaffordable at inception. The rebuttable presumption will provide a more robust set of protections for the most vulnerable borrowers, those with subprime loans. Credit is tight now. It's tight now because of lender overreaching that caused the crisis, not because of any litigation risk caused by consumer claims. A rebuttable presumption leaves room for market recovery while also creating incentives for fair lending. That's missing from a safe harbor.
Pete?
This next question is for David Moskowitz. With regards to ability to repay requirements, how do these requirements fit into how you think about basic underwriting practices?
Thanks for the question, Pete. It's entirely consistent with how we think about basic underwriting. We support the Bureau's establishment of consistent industry ability to repay standards. In the past, lenders were subject to different ability to repay standards or no standards at all, or standards that applied only to portions of the market. Too many smaller players who were not invested in the long-term success of their customers, who either didn't retain the servicing rights or who didn't keep the loan on their books, were able to utilize underwriting standards that were not sufficiently focused on the ability to repay. The market would have been better off if basic and consistent underwriting standards were in effect across the industry that were clear and that there was no departure from them. So we think of ability to repay in a way that's entirely consistent with the Bureau's approach and fundamental to sustainable home ownership. As Director Cordray said at the beginning, it's a simple and obvious principle that an ability to repay would result in the approval of a loan application only when the lender believes that a consumer has the ability to repay the loan in accordance with its terms. It's basic underwriting 101. Ability to repay standards in the final rule that embrace that concept and are applied universally will help assure sustainable home ownership and fulfill the Dodd-Frank requirements for enhanced underwriting.
Next question is for Karen Thomas. How are smaller community depository institutions viewing the ability to repay rule?
Thank you, Pete. Well, at the outset, looking at the proposed rule, the community bankers met it, frankly, with trepidation and anxiety. Like most or a lot of regulations, the regulations and the regulatory burden is kind of born of practices that community banks didn't engage in, but then they kind of get the fallout and they enjoy, I'm using that word sarcastically, the regulatory burden that goes along with it. So they were very concerned that not about the ability to repay as a concept, because after all, as I described, community banks make solid loans, and they certainly, that's what they do, take into account the ability of their customers to repay. They're more concerned about rigidity in a regulation and their ability to be flexible and provide loans to their customers that, like I said, don't necessarily fit that cookie-cutter mold. But at the same time, in the run-up to the financial crisis, you know, they watched customers who would come into their banks and who wouldn't qualify for a loan that that community bank would make. They watched those customers walk down the street and get a loan from somebody else. And those are the kinds of loans that, you know, later on blew up and caused damage to the customer. So they certainly understand the impetus for the rule. CFPB's door has been wide open to community banks during the course of this process, and we've been very grateful for that. You can see that some of the details in the rule take into account the concerns of community banks. The full rule itself will come out later today, and we look forward to reading about those details. But on the first look, we're encouraged by it. That the concerns of community banks will be taken into account. As we move through implementation and understanding of the rule, community bankers will let us know sort of where the sticking points are. The definition of, there's some special rules for rural lenders. We'll be looking closely at that definition, and our bankers will be looking as well to see if their operations fit into those definitions. Things will unfold over time. The other point I want to make is it's important to know that this rule, the QM rule, is just one piece, although arguably the most important piece, of the mortgage reforms that the CFPB is working on. So the other mortgage rules, the servicing rules, loan officer compensation, res petila, and so forth, are also going to impact community bank mortgage operations. And we have to be careful that the cumulative burden of all this doesn't push some community banks out of the mortgage market. I want to give you an example. A while back, this Federal Reserve adopted an escrow requirement rule for certain mortgages. There are many community banks that have very low mortgage volumes, and so they did not have an escrow operation. Now they were required to have escrow. They couldn't provide that to their customers, and so they had to cut off the mortgage lending that they do. That is the result that we want to avoid, because we want community banks to stay in this marketplace and be able to serve their customers.
Thank you. I would like to take a couple of minutes to follow up on some threads that were raised by a number of the panelists about the multiplicity of policy initiatives underway with respect to the mortgage business, but more broadly. Presumably, to live through a credit crisis and a financial crisis, the magnitude of which we have all suffered through, a great many things have to go wrong. Abusive practices, disastrous credit decisions, undercapitalized firms and vehicles, fragile funding structures, a great deal to fix. So naturally, there are a number of reform efforts underway. This rule clearly does not do everything, but within that context, perhaps you, Mike, within that context, how do you view the role or importance of this rule about a recovery in the mortgage markets?
The announcement and implementation of this rule will, I think, profoundly advance the recovery in the housing market for at least three ways. First, it sets this important baseline of standards for mortgages. One of the things in this housing crisis is, while many other countries had housing bubbles, the United States really stood out as having the worst quality mortgages. People were not only struck with declining house prices in the United States, they couldn't afford the basic mortgage itself, except for by refinancing in what was hopefully a never-ending appreciating market. So it addresses that which was the core flaw in the housing market in the United States. Second, it provides clarity for the secondary market. Those who provide capital for mortgages have a profound effect on which mortgages are offered. It's not just a decision of the lender or even a substantial bank itself. It's whether they can sell that loan into the secondary market. And most important, what are the risks of that? And in contrast to virtually no borrower litigation coming out of this housing crisis, there have been a tremendous number of investor claims from both private investors and government claims, so-called buyback claims, where they're able to force lenders to buy back defaulting mortgages and absorb all the cost of them. It's anticipated widely that those purchasers in the secondary market will require lenders to certify that their loans meet QM standards. That's one of the places where this standard will have a big impact. And by having the brighter line standards that are announced today that cover a wide part of the market, it gives lenders the confidence when they originate a loan that it meets that standard, and that means that when they sell it into the secondary market, they're not at undue risk that they'll have to buy it back one day. And finally, I think it validates the good work of the CFPB. I mean, the creation of the CFPB was a sea change in the regulatory world, and there was a good bit of angst and fear in the industry that it would impose unreasonable proposals and not dig into the data, into the operational concerns of consumer markets. And I think by this rule and by the comments you've heard today, it's clear that they fully did so and produced a rule that is both designed to help consumers, but also to work for industry so that there will be credit available.
Thank you. Perhaps, Professor Wachter, I could ask a variant of the same question to you. I mean, if you imagine the ability to repay rule as a necessary but presumably not sufficient condition for the return to a sensible and more vibrant mortgage lending market, what else has to happen? What are the markers that we as market participants and consumers and regulators should be looking for on the route to that return?
Of course, there's more work to be done in implementation of this rule. There's also important issues surrounding mortgage servicing rules, and of course the QRM. Further, we as a nation today remain fully reliant on a federalized mortgage system, and we need to bring private capital back. And we need to arrive at a consensus on new structures to do so. Nonetheless, the CFPB is to be congratulated. This is a major step forward. Today's rule is a major achievement.
Thank you. In the spirit of doing hard work and doing it well and doing it on time, I think we should probably thank our panelists at this point for joining us and for the valuable perspectives both today as well as throughout the rulemaking process. Thank you, and we'll move to the next phase of our public hearing.
Now it's time to hear from audience participants here today. I'm told that our audience includes community leaders, advocates, industry representatives, and of course, consumers. The open mic portion of today's field hearing is an opportunity for the CFPB to hear about your experiences with mortgages and to share your observations. Each person will have 1 to 2 minutes to tell the Bureau their story and to share their observations. And what we hear from you is invaluable. We want to hear from as many of you as possible, so I strongly encourage you to please observe the 2-minute limit so that as many folks as sign up to share their observations have the opportunity to do so. With that, I'd like to call up our first audience participant, Marceline White. One of our staff will bring a microphone to you.
Thank you. Thank you for the opportunity to speak today. Director Cordray, members of the Bureau, we appreciate you coming to Baltimore. My name is Marceline White. I'm the Executive Director of the Maryland Consumer Rights Coalition, MCRC. MCRC works to advance fairness and justice for Maryland consumers through research, education, and advocacy. I'm also a proud homeowner in Baltimore City. Thank you today. I appreciate all the work that the Bureau has done on these rules. Homeownership, as we know, is a vital avenue for wealth building, especially for low and moderate income families. We know that these families use home equity to increase their assets and to borrow against home equity to support human capital investments in their families, such as higher education. We know this is particularly true in communities of color. So we know that the work you're doing is incredibly important for all of our families, but especially low and moderate income families. It's imperative, as you said, that the mortgage lending rules adequately balance the needs of financial institutions and consumers. And it's important that it opens up and provides more access to credit, as well as clear and transparent standards for borrowers and for lenders. However, our concern right now is that, as written, the rule does too much to protect banks at the expense of working families. Our concerns are that the safe harbor in the qualified mortgage rule provides too much of a legal shield for financial institutions, and it absolves them of most of the liability around the ability to repay. Our concern is that as the rules defined, most mortgages will qualify as QMs and will be shielded from lawsuits. This kind of safe harbor provision serves to protect financial servicers while casting homeowners out to sea. We believe there should be a rebuttable presumption for all loans. We also believe that the proposed QM rule assumes that financial institutions have engaged in sound underwriting despite clear evidence to the contrary over the past 10 years. We understand the impetus of the rule and the motivation. However, we know that banks and financial institutions should have always been engaged in sound underwriting policies, and that has not been the case. We hope the rule will go further to redress that, and we think the standards are important for consumers, but have very strong concerns about the safe harbor provisions. We're also concerned that the inclusion of the 43% debt-to-income ratio may price out low and moderate income families who would like to purchase a loan and would like you to continue to look at that issue.
Thank you, Ms. White.
Yep. And I'm just going to say, I'm going to end that we simply appreciate the work you've been doing and would like to make sure that you continue to engage people on the ground on these issues.
Thank you for your comments and thank you for the work you do in Baltimore. Our next audience participant is Yaneth Milan.
Hi, my name is Janet Milan, and I'm actually an occupational therapist, and I work for the Baltimore public school system. And I'm here to represent not only the Latino community, but all Americans that have been struggling to maintain the American dream to own a house. Actually, in your system, like if you had a paper plotted, you can write it down. I am number 12021300391, but today I'm a real story, and that's why everybody's here. I had actually a complaint with the agency because I have a subprime loan with an interest rate of 6.87%. And in about like 3 years, it's going to go up to $700. I tried to obtain a loan modification, but I never was able to get that modification. And I'm really happy now that you're having new rules to prevent further abuses. But now I'm wondering what actually your agency is going to be doing for people like me that are still struggling to make their home payments with subprime loans. I think that we live in a great country, and definitely we are here because we can make all dreams come true if you really work hard. We are all accountable for what we do, and I would like to know also how your agency is reviewing and tracking all the complaints that you have, and how are you making sure you are offering a timely response to your people.
Thank you, Ms. Milan. I'm sure you have our staff in Washington, D.C. furiously looking up your complaint. We have your contact information, and we'll make sure that staff follows up with you. Thank you for your work with the Baltimore public school system. Our next audience participant is Mike Morin. Do we have Rod Statz?
Thank you. I'm President and CEO of CQ here in Maryland, and I'm also here on behalf of CUNA, Credit Union National Association. First of all, we feel the agency has generally developed an approach regarding safe harbor for lower priced mortgage loans and a rebuttable presumption for higher priced ones that should be workable for consumers while avoiding disruptions in the mortgage market based on lenders' fears of increased liability and so on. We commend your efforts on this particular issue. We also appreciate that the Bureau is allowing a temporary exemption from the qualified mortgage general 43% debt-to-income ratio requirement for loans that will meet the eligibility requirements of the GSEs. So we really appreciate that as well. And however, we remain concerned that there may be instances where higher debt-to-income ratio may be appropriate for certain borrowers, especially with us as we deal with our own members and you know what the credit unions do and what they do for their members. And so we'll be closely reviewing this aspect of the final rule. Given the scope of the rulemakings that are pending at the agency, we wanted to reinforce our members' concerns and again urge the agency to do all it can to contain new regulatory requirements for credit unions. Some of the issues expressed by the community bankers, as you well know, are the same issues that we have, especially for some of our smaller credit unions and being able to adapt to the myriad of regulations that are going to be thrown their way. CUNA commends the efforts of the Bureau and the general appreciation of the work of the credit unions that you, Director Cordray, and your staff continue to express. We greatly appreciate the time that you have spent with us and your willingness to listen to how we do business and how we can help our members. Nonetheless, credit unions remain very concerned about the barrage of regulatory actions that could come their way. And we've had discussions with those, and you're very well aware of those. Now that's CUNA's part. On the part of CQ, a quick little mention that, you know, when you talk about no doc, low doc, interest only, negative amortization, hybrids, option adjustable, we didn't do any of those. We never did, and we never planned to do any of those. So as we move forward, a lot of what you're suggesting here, we've been doing over time anyway. We just want to make sure that there's ample time to make sure that we've got it all in place and that it works effectively for our members and for us. And if Congressman Cummings were here and Senator Cardin were here, they mentioned about the hearings that they have held, or not the hearings, but the outreach sessions to help. You know what our members needed during this financial crisis? A phone. Because all they had to do was pick up the phone and call us, and we would work through the situations with them. And we didn't need to be told what to do in those cases. As a matter of fact, we had an outreach program in our newsletter that said, talk to us if you're having issues because we will work with you. That's how much we care about our members. Lastly, Director Cordray, I want to thank you. Last night you made a call to Bill Cheney to talk to him about this rule, and we really appreciate, again, that call and the cooperation that you've shown with us as we try and work through all of this. Last thing is, will the rule be published this afternoon, the final rule?
We're very hopeful that the rule will be published this afternoon. I'm getting a thumbs up.
The prompting we're getting is heads nodding. So.
Okay, all right.
Thank you, Mr. Stats. Mary Hunter.
That's
Joe Rogers. Edsel Brown.
Good afternoon. It is indeed a pleasure to be here. My name is Edsel Brown, and I'm representing the Maryland State NAACP. And I would like to say on behalf of our membership that the mortgage issue very adversely impacted our community. Similar to Congressman Cummings, we had a number of workshops and hearings around the state, and I can't tell you how many stories I could relay to you about horror stories that people experience. So we appreciate this first step that you're taking to make improvements in the status quo, but while the bright lights are shining and everybody's here, everything's well and good, but this is a first step. It's not a last step. And we're looking to improve the process as we move forward. I've been involved in other regulatory processes, and again, there's always holes in the fence. Now, there's always attorneys, associations, et cetera, that are going to find the holes in the fence. And let's make sure that this isn't like a one-time thing over the next 2 or 3 years. I'd like to mention a couple of other things. One is information. Information is power, and organizations like the NAACP and other community organizations need to get this information on the front end, not the back end. Also, partnerships. My colleague, who just spoke a little bit earlier, made a few comments. And one thing that I like to say, there's been a very severe breach of trust. So, you have a number of consumers that even if you call them up or reach out to them, they don't trust you. So we have to rehabilitate and build that trust back up. But again, I just want to thank you for this opportunity to speak. But again, beginning, not an end.
Thank you, Mr. Brown. We agree with that. Robert Kerwin. Reverend Gloria, pardon my mispronunciation. Oh, great.
There you go. Okay, Reverend.
Thank you very much. My name is Pastor Gloria Jones Swearinga. I'm co-chair of Communities United of Greater Washington. I'm also a sitting commissioner on the Commission for Persons with Disabilities for the County of Prince George, Maryland. And I also want to commend you for your very important first steps towards resolving a very egregious problem with regard to predatory lending. I myself am a predatory lending survivor. However, I am very concerned as to whether or not the protections built into your efforts are adequate enough for people who are particularly vulnerable, such as folks like myself who are totally print disabled. One of the things I would really like to happen is to get a copy of your proposal in some audio form. I do not have immediate computer access, and unless God changes his mind, I'm not going to be able to read the printed page. But one concern that I do have is a safe harbor for borrowers. And I'll use myself as an example. My predatory lender has been in enthusiastic violation of a modification contract signed in October '07 for quite a few years. I'm paying almost $200 outside the agreed upon sum. I have just learned a couple of months ago that my predatory lender is in India and that they don't even have a standing office in America, that they have abandoned this country, taking my insurance coverage with it. I use that as an example because if I were a Lone Ranger, that would be beyond egregious. But as a member of the National Home Defenders League, I can tell you that there are no Lone Rangers. There are people whose disability is age. I'm 75. There are people whose disability is lack of information. So my point of encouragement, the banks already have more protection than we do. In every single hopeful sign, when it finally blossoms into reality, the bank is better protected than the borrower. At some point, we have to arrive at a situation where somebody who's going through the types of experience I'm having, and I'm in a discussion with your organization, has somewhere to go where totally egregious, predatory, criminal, literally extortionist activity, when you're talking about the roof over your head, can be adequately addressed. So in the safe harbor concept, we need to see a safe harbor that adequately extends access to sufficient protection over the borrower. Or down the road, we're going to find the foxes back in the hen house. We'll be hemorrhaging houses again, and neighborhoods, families, and society will again be experiencing the trauma of a housing shortage. Thank you.
Thank you, Reverend Swearinga. Chris, can you please gather her contact information so that we can be responsive to her request? Thank you, Reverend, for the work that you do in Baltimore. It's important work, and we hope that you continue to be able to carry it out for many, many, many years to come. Douglas Kraus. Robin Ayele. Brian, oh, there we are. Robin Ayele.
Hi, I'm Robin Yelly with Baltimore Neighborhoods, and I want to know what will be done, how will you ensure that borrowers will not be will be able to get loans in the future, and low interest loans, those that deserve to get low interest loans.
Would CFPB staff want to take
for the underserved borrowers?
Sure.
So today's rule should both increase confidence in the mortgage market so that lenders feel more ability to lend, and consumers can feel more ability to look for loans and go to the closing table without being set up to fail. In both of those respects, having a stronger market that has better consumer protections, really, as Mike said on the panel, is good for lenders and for borrowers and should be good for the market. In terms of how the market will evolve over time, we're just going to have to see. We don't control all those details. We cannot mandate that a lender lend to any particular consumer. We can just set up the right framework so that we think we can root out the kind of reckless lending abuses that were so endemic before the crisis. And we think that having done so, we're going to open space for the kind of responsible community banks and credit union lenders that we talked about, some of the other programs we're talking about, some of the nonprofit groups and others, and the main lending community to be more confident about their ability to lend to homeowners, and that the market will support that, and that they won't have to compete against some of the bottom-of-the-barrel, deceptive, abusive, misleading types of loans that they were competing against. And then we're just going to have to see how the market evolves from here.
Okay. Thank you. Brian Cusick. Carrie Hunt.
Good afternoon. My name is Carrie Hunt, and I am the Vice President of Regulatory Affairs for the National Association of Federal Credit Unions. I hope we have some federal credit union members here today. Yes? No? Excellent. As you know, credit unions are charged with providing provident credit to this country. It's something that Congress has specifically told us that we need to do, and I think that is a shared goal that we have with the CFPB. I want to thank Director Cordray and all the CFPB staff for all of the hard work that you all have done on this rule. Specifically at NAFCU, my job is to make sure that our credit union members have rules that they can live with, that they can work with, that really helps them do their job in lending to consumers. And as I've worked with your staff, we've expressed concerns, and we've tried to really express why we need a rulemaking that is effective. I hope that as we move forward, we really can take a hard look at the regime that's been created. And if it looks like that credit unions can't lend, that rules are too restrictive, that really consumers who qualify, who have the ability to repay loans, aren't getting them, that we take a second look at what this country is doing. And I would certainly hope that the CFPB would partner with us in working to make sure that that doesn't happen. We really appreciate that you asked for comments on credit unions and small banks to make sure that we can lend. And hopefully we will continue to do what we do best moving forward, which is what credit unions really want to do.
Thank you, Ms.
really.
Hunt. Kathleen Skolny.
Thank you for taking my comments. Those of you who know me know that I usually don't need a microphone. But I'm very glad to see CFPB here in the Baltimore community. I am a practicing attorney in Maryland. I have represented homeowners in foreclosure defense and mortgage-related claims for 12 years and have recently retired from legal aid. I was also privileged to be part of the governor's task force that resulted in significant homeowner protections in the statutory foreclosure process. I also was privileged to sit on the committee that revised the court rules. I'd really like to comment on my concerns over the safe harbor and specifically join the Reverend in her concerns. We are told here today that the safe harbor is necessary as an incentive to sort of kickstart or break open, if you will, the credit access that's so bottled up. We also heard that this is a result, that the whole meltdown was a result of some reckless assumptions and so on. It was really the result of fraud and mind-boggling manipulation of the global financial markets. It really was, and we all know this. What borrowers did had very little to do with where we ended up. We're very glad to see that we are finally getting some regulation related to this. Back when the earth was cooling, I was a securities broker. Back when 60 million shares was a big day, and securitization actually made sense. What I would like to express is my concern and the concern of my colleagues who practice in this area, that if there's a safe harbor, such as being detailed in this rule, that it be subject to simple rebut. The rebuttable presumption limited to the subprime borrowers really makes no sense, and all borrowers are entitled to affordable mortgages, and that a mortgage being affordable should be subject simply to a broad rebuttable presumption, not a nearly absolute presumption. By the way, Maryland has an affordability statute, and consumers did not have to, and borrowers did not have to relinquish their right for total unfettered access to the courts in order to get that affordability requirement. So we would like to see that broadened, the rebuttable presumption broadened to all borrowers. Thank you.
Thank you for your comments, Ms. Skolny. John Sullivan.
Good afternoon, and thank you very much for the opportunity. I'm John Sullivan from the Buyer's Edge and former president of the National Association of Exclusive Buyer Agents. My question to Mr. Cordray is, in your prepared remarks, you referred to the true essence of responsible lending, and I applaud you for your efforts on instituting reasonable regulation. You also refer to reckless lending practices that cause a housing foreclosure crisis. But the vast majority of those cases, there was a real estate agent who knew or should have known that the home buyer didn't have the ability to meet his or her financial commitments. The real estate agent or broker, like the lender, like the lender's loan officer, got a commission and hasn't been seen since. Unfortunately, the Dodd-Frank bill, which created your bureau, contained language that prohibits you from any enforcement action against any real estate agents or brokers. My question to you, sir, is there anybody at your bureau who has enough wherewithal to stand up to the lobbying efforts of NAR to ask Congress to eliminate those provisions in the Dodd-Frank bill? and require the real estate community to make the consumer aware of their agency choices when selecting the agent to guide the consumer through the maze of home buying. At the present time, there are 50 state regulations, none of them alike, some of them calling the same type of agency a different name. We need some regulation at a national level on agency disclosure to make sure that the consumer is protected when they're making the biggest purchase of their life.
Thank you, Mr. Sullivan. Allison Wang.
Hi, my name is Allison Huang, and I'm an interested consumer. And I'd like to know, a trend in the employment market is the increasing percentage of the population whose income mimics the self-employed, whether they are hourly workers or independent contractors or freelancers. What protections does the rule offer to ensure full access to the credit markets in light of the burden of proof of ability to repay, so for those workers who may not fit the traditional model of a 40-hour work week, salaried employee, or tenured employee?
Pete, do you want to take a crack at that?
So the new ability to repay rule does include provisions for creditors to verify and consider income. So verifying income documentation is a very critical part of this rule, making sure that verified information is used in any debt-to-income ratio determination. As you point out, self-employed borrowers are a big segment in the market, and the rules we're putting forth do provide guidance for how self-employed borrowers should be considered. They should not be locked out of the markets as a result of this rule. They are factored into the guidance we provide, both within the ability to repay standard and as well as within the qualified mortgage standard.
Thank you, Ms. Wang. Vicki Titano.
I'd like to just say something to the previous question, which is I was not in Washington when Dodd-Frank was fiercely lobbied over. I know it was. There were a number of exemptions written into that law. Although to the extent entities are providing financial products or services to consumers, those exemptions are somewhat complex. I'm sure down the road there will be further consideration in Congress of how all the act is playing out. But I want to point out that one important feature that is new is that the Consumer Bureau is now in place to oversee not only financial institutions that have a charter, banks and thrifts and savings and loans, as was true before Dodd-Frank, but also non-bank mortgage lenders and others who participate in this market. And it's very important because you can't have a satisfactory or successful regulatory scheme that covers part of a market and leaves the rest uncovered. What you find is what ICBA noted on the panel, Karen noted, people going down the street and getting irresponsible loans from people who are not subject to any standards, and that cutting into the market for more responsible lending. That's the fact that this rule is now in place and that it covers the entirety, for the most part, of the mortgage lending market, I think is a very notable step forward.
Thank you for the comments, Director Cordray. Our last audience participant is Vicki Titano. Thank you all for joining us today in Baltimore on the CFPB's field hearing on the ability to repay in qualified mortgage rule. What we hear from you all, the wide array of interests represented here, is very important. We listened very carefully, so we thank you for taking time from your day to talk to us.
Well done. Thank you. I was still thinking about the previous one.